versus just saying like, okay, you have a high risk tolerance. We're going to put you all in high growth stocks, or you have a low risk tolerance, so we're going to keep you all in bonds.
Hello, and welcome back to another episode of the Retire While You Work podcast. I'm Carson, a financial advisor here at Adams Wealth Partners. With me is Myles another wealth advisor here at Adams Wealth Partners. And we're going to get into the kind of the essence of what we do today, talking about some risk tolerance, but not before. We're recording this the week of 4th of July, and then I get to head out on my annual beach trip down to Florida at the end of this week. Myles, you gonna shoot any fireworks off this week?
I don't have any, so I guess I would have to go pick some up. Don't plan on doing that either, so I suppose not. I'll just
gotta at least get some pop-its, right?
Yeah, or just let other people in the neighborhood start, shooting them off at 10:30 p.m. all weekend and keeping you up. You always love that. Guess I probably sound like an old grumpy man saying that, but I think we can all agree that's not the most pleasant thing.
Just wait until you have kids. I don't think we bought very many fireworks, and then having kids, yeah, I mean, you have to buy fireworks. They absolutely love it. So,
do they do a show like in your neighborhood?
Neighborhood has a show. Town of Smyrna, Town of Murfreesboro, Nashville, everybody has shows doing it. So
yeah,
we really don't have to do much of our own. We may spend, I don't know, $50 on some fireworks, just do a little bit in the driveway.
Okay.
Not much.
Stay safe. Yep. Keep all your fingers.
That's right. Really, to get into it this week, one of the most important things we do when we manage client assets is revolved around risk tolerance, and really how comfortable a client is with investing their money in the stock market. Because believe it or not, stock market's extremely volatile. It goes up, it goes down. Same with bonds. Bonds go up and they go down. And different people are raised with some people with a high risk tolerance. Some people are raised with a low risk tolerance. And we very heavily take that into account before we recommend a certain asset allocation or how a client should be invested. So going way back here, Myles, would you say your risk tolerance is generally pretty high? Not just stock market, but just in life in general. Do you have a pretty high risk tolerance or relatively low?
I wouldn't say I have like the highest risk tolerance, but I wouldn't say that I'm like, the person that wants everything in cash, and if I lose a cent, I'm going crazy. I think I have like a healthy risk tolerance, and I think maybe some clients who come or prospects that come and meet with us who feel like maybe they have a high risk tolerance, they have a low risk tolerance, maybe just don't understand, exactly what that means even. And so I think we do a good job of talking about where the assets are and what the purpose of the assets are, and balancing out that risk tolerance as part of the financial plan versus just saying like, okay, you have a high risk tolerance, we're going to put you all in high growth stocks, or you have a low risk tolerance, so we're going to keep you all in bonds. I think we're working with an advisor, us, anybody else who does what we do, really helps people out is, taking into account maybe how somebody feels about things and what their risk tolerance is, but then working with them and coaching them towards where they need to be to have a successful financial plan, and not just, stick to where they're comfortable at.
It's good. I think I'm more, I don't know, a scale of 1 to 10 for risk tolerance.
I think it's always hard. Like,
it is
I know
hard.
I think we have that on our questionnaire for prospects, but I'm like, it's kind of a confusing thing.
Especially, my risk tolerance when it comes to real estate might be different than stock market stuff, and it might be different in the insurance world, so on and so forth. But I mean, I think generally maybe I'm around a 6 or 7 when it comes to risk tolerance. Like, I'm not afraid to take risk, especially with investments, because I have long-term time horizon in my mind. But there may be certain areas that I'm not going to take a lot of risk. Like, I don't know an example off my head, but I think
one thing I like to do is, like, if it's specific money for something, like whether it's for retirement or maybe to buy some sort of real estate property, is thinking about like, if I'm going to put this chunk of money towards that, what's the worst thing that could happen with that? Like, could it go to zero? Could I lose 10%? I mean, whatever it may happen. And when I think about it that way, I'm like, okay, the worst thing that can happen that I see after analyzing this is X. I'm comfortable with that result. If the result that could happen is X amount return also. So I like to look at it from kind of what do I feel is like not even the best case, but maybe like what's a medium success case that I'm happy with. And also on the downside, what's, what I do feel is the worst case that could happen to balance. And then that's kind of how I make decisions based on those couple things to get comfortable with it.
Yeah. And that's the essence of risk tolerance is it comes from you're trying to ask yourself, obviously we all want to make returns. We all want to make money, have positive performance in our investments, no matter what that investment is. But to a certain degree, relatively on the efficient frontier, the more risk you take, the greater likelihood for higher return. Not always true, but that's generally the perceived principle that more risk equals more return. Again, broadly, it's not always the case. So with risk tolerance, it's also directly correlated with time horizon. So for example, if I'm have 30 years until I'm planning to retire, my risk tolerance in that bucket of money that I'm planning to use for my retirement 30 years from now, because I have 30 years, my risk tolerance can afford to be extremely high for me personally, because I know I'm not even worried about 10-year performance of my investment. I'm truly worried about the end result of 30 years plus. Therefore, I'm comfortable with an extremely high amount of risk with what in that specific retirement investment because my time horizon is so long. Now you go on the other extreme of that, an example would be maybe you're saving up for a down payment on a house for 12, 24 months from now, a year or two, then my time horizon is extremely short, 1 to 2 years. Therefore, my risk tolerance needs to be extremely low because I cannot afford to lose any sort of money on this investment because I'm going to need it extremely soon. And there's not a lot of investments out there other than cash or cash alternatives in this scenario that can be safe a year or two from now. So that's just another way to look at your risk tolerance. The longer your time horizon is a pretty good rule of thumb to be able to afford you more risk. I don't know what that risk is, but just more compared to money that you're going to need inside of a year or two, if that makes
Yeah,
sense.
I would agree with that. And I think that's where the three buckets that we use, everybody comes into play. And I think maybe before somebody comes and sits down with us, they're just thinking about like all the money that they have in general and how much risk am I willing to take with this. But to your point, Carson, if you say, okay, this chunk of money's for this chunk of money's for this chunk of money's for this, you're then able to say, okay, I'm willing to take this much risk on this money because to your point, you might want it for a house in the next year or two. I'm willing to take this much risk with this because maybe I need it in 3 to 5 years or as a general extension of my emergency fund. But this retirement bucket, I don't need for 30 years. I'm willing to be pretty aggressive with that. And if I see some big swings in it, I'm okay with that because I know over the long run, it should be higher. Not always going to be the case, but especially if you're just maybe in, a couple individual stocks, that becomes a little less predictable. But if it's in a well-diversified growth portfolio, can't say guaranteed, but chances are it will be higher in 30 years than it is today.
That's right. And to kind of equate what we mean with risk tolerance and aggressiveness, time horizon kind of dictates how aggressive you can be. If we're, from how we're investing in the stock market and bond market, let's just, I'm gonna share a graphic here if you're listening on YouTube, but if you're listening on our podcast, then I'll kind of explain the graphic that I'm sharing. But this is essentially data over the past decade of the two core investments that we invest in: stock market and the bond market. The line in the purple over the past 10 years, that's the S&P 500. So just broad US stock market returned over 230% over the past decade. The Bloomberg aggregate, this is the global aggregate, so not the US ag. Its total return is close to 0% over the past 10 years. Now, a lot of the return was given up in 2022, whenever the bond market had one of its worst years in history with the fast pace of interest rate hikes that occurred then. But you can see even in the S&P 500, there are some massive, massive spikes of volatility. For example, right after 2020, there's that huge downside that we had, like down over 30% in 30 days. I just wanted to show this graphic to point out there's tons of volatility. Yes, the general direction is up and to the right for the S&P 500, but it's not without some major 20 and 30% dips along the way. And that's only going to continue to happen. So whenever we're talking about the stock market and bond market, risk on usually means being heavier weighted towards stocks, and risk off and more conservative usually means being more heavily weighted towards bonds and cash alternatives. So, for example, Myles, you, me, we're young, we have retirement accounts. My retirement account asset allocation is going to be pretty much all stock market related because, as you can see in that graphic, bonds don't do a whole lot. They have a lot less volatility and a lot less long-term price appreciation. Therefore, since my time horizon is so long, I'm going to go full on into the stock market because I can be the most aggressive with that money. The opposite of which would be if I need to be conservative, the most conservative is cash, or you could be 100% bonds if you're just looking to clip some yield and live off the coupons from it. So we get risk tolerance. We equate that to asset allocation between stocks and bonds.
Yeah, I think that's pretty well said. And what would you say if, like, obviously we've talked kind of a lot about a big piece of it is having a conversation with an advisor or somebody like us to help come up with what's the right balance or mix for somebody. But like if somebody's maybe a do-it-yourselfer, kind of enjoyed doing some investing on their own, how would you recommend, what's maybe one thing you'd recommend for somebody like that who just kind of wants to do it on their own? Maybe they feel like they don't have enough to work with somebody and just kind of want to focus more on growing it. How would you recommend maybe they assess their risk tolerance?
I would say look back at a great example, one of the worst recessions we had, the financial crisis in 2008. I think that's a good benchmark to look back and say, okay, how did a 100% stock portfolio do in 2008? How did a 50% stock, 50% bond portfolio do in 2008? And then finally look at a 100% bond portfolio do in 2008. One, that can enable you to gauge how is my portfolio going to perform in a really, really bad market alongside a recession. But then, so that's the first part of it. But then two, in a year like 2023, where the stock market really went up, but bonds didn't do much, do the same thing, because you can't get all the downside protection, but also all the upside participation. If only it worked like that. But so that you understand, if I want to minimize my downside, I'm going to have to give up something on the upside. So then look in 2023, look and say, okay, 100% stock model, I'm making these numbers up, but was up 20, 50% stock model was up 9, and an all bond model might have only been up 1% in 2023, for example. So look back at past performance of some asset allocation models of, like I said, 100% stock or 50-50 stock to bond or 100% bond, and learn to say, would I be emotionally okay if I saw my portfolio go down X%? Or would I be emotionally okay if I saw my portfolio only go up 10 when the market's up 20? That way you can prepare yourself and set expectations to know, regardless of what the market's doing, I'm going to be okay because my risk tolerance is in this zone of protection and participation.
Yeah. And I would say that I think some of our best clients, some of the best investors out there, the first time you go through something like that, it's not going to feel real great. Like the first time the market's on 20% and maybe you're not on 20, but you're down 15 and you worked hard to save this money and you're kind of watching it, go down a little bit, that it's really hard. And then maybe that next year it snaps back. And the more cycles you go through like that and continue to see your money grow, I think the better investor you become in one of those years where, in one of the first years where you see it down, it's tough. But as soon as you see it coming back, you're like, okay, I can take a breath, feel a little bit better about things. And then obviously over, 3, 5, 10, 15, 20 years, as you see your account balance grow and really solid performance, I think that's when people become the best investors.
And one thing, regardless of if you have a financial advisor, if you work with us, do it on your own, we want to make decisions with our finances not with our emotions. We want to use just fundamental decision making to decide our risk tolerance and long-term view of money and how we're investing. But that's not to say that emotions aren't real, because I think in 2022, which was the worst year in the stock market since 2008, those emotions are real, even for professionals. Don't sit here and think that just because someone's a professional or a great investor that they don't get emotional. Because imagine seeing you have $1 million portfolio, it's down 25%, it's down to $750,000. That's $250,000 that's gone. That's been wiped out from market performance. Emotions are real. But the best investors know, especially if they have the long-term time horizon, that it's going to come back. And the best thing to do with your emotions during times of volatility and whenever the market's performing bad is talk it out. Talk it out with someone who's lived through it, who can coach you through it, to remind you this is what's happening in the stock market. This is why we're invested the way we are. Remember, here's what you told us your risk tolerance was. Here's why we're invested, this percentage in stocks and this percentage in bonds. Let's talk it out and remind ourselves, if this is money that you don't need for 10 years, then it's going to be okay. You saw the chart that I showed with the S&P 500 and the ag and how they've performed in the past. And there's going to absolutely be times of volatility. Be aware of your emotions. Don't act on your emotions, but talk them out. That's one of the biggest things I feel like I can recommend.
Yeah. And I think also in a year like that, maybe when the market's down, is look for opportunities. I mean, because there's strategic things you can do, not to go too far in the weeds, but like tax loss harvesting and, purposely taking some losses, selling one thing and immediately buying another to harvest those losses so that when you have gains in the future, they can cancel each other out. And so just being smart like that. And to Carson's point, having conversations with your advisor or whoever you feel is kind of a close confidant that you can have those conversations with, and just reviewing things and making sure that, things are where you want them to be. Maybe you need to make a slight tweak, but trying to stay as disciplined as you can to the overall financial plan and the goals that said were important whenever you put them in place, and just consistently reviewing things. I think it's always good to do at a minimum once a year, probably 2 or 3 times a year, just to make sure that the way your money is invested is in line with your goals, which are directly tied to your risk tolerance.
That's right. Yeah, that's good. Risk tolerance is extremely important because we're humans. We're not robots when it comes to investing in the stock market. Yes, in a perfect world, you'd invest your money and be completely unemotional to it, but that's not how humans are designed. So that's why we have risk tolerance, to manage our risk and manage expectations about stock market future returns in our own portfolio. So just to sum it up, take it seriously, your risk tolerance, review it, like Myles said, once a year, twice a year, however often is needed, or if there's a big change that's happening. Seek the advice of professionals, do some review on it, and set yourself reasonable expectations, because that's the biggest thing with the stock market. If you expect to know, or if you know that there's going to be a 30% drop in the market, then when it comes, you're not going to be surprised. Like you said, Myles, maybe you'll be on the offensive and take it as an opportunity to buy stocks when everybody else is selling stocks. As Warren Buffett says, be fearful when others are greedy, and greedy when others are fearful. So overall, being aware of your risk tolerance makes you a better investor in the stock market.
Yeah, I think that's well said. And I would just add to kind of Carson's point, and what we said before, is just always be looking for opportunities. I think even when there's a down market, one, you want to overreact, or two, you maybe even underreact and just kind of freeze up. But I think there's always some opportunities, even in those bad years, to improve upon things or be strategic with your overall financial plan for the betterment of it, 1, 2, 3 years down the road.
That's it. That's good.
Well, thanks everybody for joining us. I guess this will come out probably after Thursday, which is the 4th of July, but I hope everybody had a safe and fun 4th of July. And if you're here local in Tennessee, stay cool. It's been a scorcher here for the last about 10 days. So
it has been brutal.
If you're going to be at the beach like Carson is maybe next week, enjoy some of the cool water.
Yep. Thanks for listening.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.